Hey, good evening, everyone. Thank you for joining today's Corporate Connect session. My name is Sunny, your host for today. Today, we welcome a United Hampshire US REIT to our Corporate Connect session, as well as we welcome our audience from our partner platform, Mumu Live. So this webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with the market highlight by my good friend, Mr. Geoff Howie, market strategist at SGX, followed by a corporate presentation by United Hampshire US REIT management team, including the CEO, Mr. Gerard Yuen. United Hampshire US REIT is a Singapore-based real estate investment trust focused on US retail properties. The REITs primarily invest in groceries, anchors, and necessity-based retail properties, targeting tenants that are resilient to the impact of e-commerce. UHREIT's portfolio consists of a diverse range of properties, including modern self-storage facilities located primarily in the East Coast of the US. But before we dive deeper into UHREITs, let's welcome Geoff Howie to share with us the latest market highlights. Over to you, Geoff.
Thanks so much, Sunny. Great to be here with SIAS. And of course, two causes that SIAS champion very well is good corporate governance and investor education. And the latter is what we're focusing on tonight with investor education. So for this quick 10-minute session thereabouts, what I'm going to do is just give a brief overview of some of the recent highlights in our REIT market. We currently list in Singapore 32 real estate investment trusts, including as well as 5 staple trusts and 2 property trusts. Those 39 what we call S-REITs in total have a combined market capitalization of around 100 billion Singapore dollars. The sector is very well balanced over diversified REITs, industrial REITs, retail REITs, hospitality REITs, commercial REITs, as well as investing in specialized property assets. Diversified REITs are now the biggest portion of our REIT market. And they also are very well diversified by where in the world they invest. In Singapore, there's as many as 17 of these trusts that exclusively invest in properties outside Singapore. Then you have another 20 that are investing in properties in both Singapore and outside of Singapore. And then you have the remaining 3 REITs investing purely within Singapore. On the international front, this includes, there's as many as 10 trusts that have exposure to the property market in China, varied degrees in terms of the percentage of the portfolios that those properties make up. We have about 14 trusts now with properties in Japan, and we have, of course, 9 properties that have, 9 REITs that have properties in the United States, 5 of which report all their revenue to the United States, including United Hampshire US REIT. I guess in recent years, these REITs, as I said, now worth $100 billion of the total market cap. But on a day-to-day basis, you're generally around 20 cents in every dollar that changes hands in the stock market is going to work in the REIT market. When times have been a little bit quieter in the REIT market, like earlier this year, that can fall down to 15 cents in the dollar. But when the REIT markets are very much in play, that can be as much as 30 cents in the dollar of the trading turnover in our market going to work in that S-REIT sector. Let me go to the next slide. I just wanted to relay this very recent highlight too, because not just the S-REITs themselves that have seen increased participation recently. The local and the broader REIT sector very much has been a cornerstone of the 20 exchange traded funds that we've listed or debuted in our stock market since 2020. On the 3rd of October, the combined assets under management of the 5 REIT tracking ETFs reached an all-time record of 1.04 billion Singapore dollars. And it was back in mid-September, on the 13th of September, that the combined AUM of those 5 REIT tracking ETFs reached above $1 billion. That's not insignificant, because the combined AUM of the 2 STI ETFs is around 2 billion Sing dollars. And it actually took 17 years for those two REIT STI ETFs to reach 1 billion in combined AUM. So obviously there is a healthy interest in these REIT ETFs at the moment, and that increased allocation and participation in those 5 REIT ETFs, it's also coincided with a decline in the local 6-month T-bill yields from near 3.8% at the end of June to around 3.05% at present. And this has also coincided with a decline in the US 2-year yield since the end of June, with the 2-year yields moving lower from 4.8% to around 4.05% at present. So the iEdge S-REIT index, our benchmark for the sector, it currently sits at around 1100. That's 1,100. It's risen from 980 at the end of June to a high of around 1150 at September. So that 15% rally that we had in the third quarter in the index level, with 2% return in distributions, took the total return of the index in the third quarter to 17%. So I've got years of price movement for the index, and the index is represented by the bright white line in this chart that I took off from Bloomberg today. The dotted line at the top, this little dotted line here, represents the 12-month consensus estimate price for the REIT index at the time. Okay, so what's largely driven this move in the third quarter is the FOMC cutting the Fed funds rate by 50 basis points back on the September the 18th. It's come back a little bit since, because the expectations for the size of, or the quantum of, the interest rate cuts over the next FOMC meetings, it has come back a little bit less accommodated. So what I guess I wanted to show you is this little dotted line here has also crept up recently too. That's, as I said, the 12-month consensus estimate target price of the index. Now, consensus estimate target prices are generally taken as an average or a median of where analysts potentially see a stock in 12 months. So what we've got to do before you get a 12-month consensus estimate target price on the index, you've got to get your target prices for the actual stocks themselves. So, for instance, according to Bloomberg, you have multiple analysts covering the S-REIT United Hampshire US REIT. You have Jonathan at UOB Cayenne. He has a buy recommendation and a target price of 64 US cents. And then you have Alyssa at KGI, who also has an outperform on the stock with a target price of 60 US cents. So you take the 64 US cents and the 60 US cents, and that brings your consensus estimate price to 62 US cents. So you have a consensus estimate target price for the stock. And then all the index consensus is actually doing is just looking at all the individual REITs that are constituents of the index. So you look at all the consensus estimate target prices of all the different index constituents, and you use the size or the weight of the REIT within the index to then extrapolate where analysts see the actual price in the index in the next 12 months. So that's how we've got this little dotted white line here. So if you look over this little dotted white line as well, you can see that over the past 5 years, your 12-month consensus estimate target price of the index has generally, on average, always been around 12% higher than the index. So it's presently around 10% higher than the index, and that's after it was as much as 20% higher than the index at the end of June. And that was, that was one of those gaps that we were pointing out then, and therefore you've seen that difference revert back to the average. Another way to look at the pricing of the REIT index compared to where it's been in the last 5 years as well is looking at the price to book ratio. So at the moment, the price to book ratio is at 0.93 times the, so it's just below book value, 7% below book value. And interesting too, the average price to book ratio over the last 5 years for the index is pretty much also exactly 1.00. So what you can see is that has actually the price to book ratio is still below your average at 0.93, below the 5-year average of 1.0. But what the move in the third quarter of this year has done is returned that price to book ratio from below, return from below to above the one standard deviation threshold below the actual 5-year average price to book ratio. So you can see for much of the time that price to book ratio spent much time below that one standard deviation threshold, and it got very close to that 2 standard deviation level as well back in late 2023 before we had that very strong rally going into the back end of that year. Another really key thing I wanted to sort of point out at that index is that when you, and this is really crucial for REITs, is that you can see this white line starts up here at around 1450. And then, as we said before, it's down around 1100, closed at 1104 yesterday. Now, you can see that kind of shows you've had a decline over that time. But the interesting thing is when you take the distributions into consideration over the 5 years, your IHS REIT index is exactly flat, 0%. Not a gainer, not a loser, but over the 5 years, all that performance gap in terms of the units was returned to the investors. So if you assume investors are reinvesting those distributions into the REIT units, your total return of the white line is actually flat over the 5-year period. Overarching market consensus for real estate stocks, I think, is generally the thought is that after your tighter financial conditions, which have had some desired overarching impact in cooling inflation, by extension, containing some growth, those lower rates are now changing the equation to be more in favor of growth, which is very important. In the US market, you actually had REITs performing quite well before you actually had the little bit of a catch-up rally that we saw in our market ahead of the September FOMC. It was interesting that in the first quarter of this year and in the second quarter of this year, you had twice as many REITs beat expectations as those that missed expectations in the US. So we've long maintained growth drivers are really important for the sector and for our sector here. Obviously, key factors to watch in this second half of the year include occupancy rates of the REITs, positive rental reversions, asset enhancement initiatives as well. And I guess additionally, maintaining and engaging a very diverse tenant base is important, proactive capital management, and obviously having that capacity for accretive transactions. These all kind of provide this conducive environment for growth of the portfolio. I should point out too that lower borrowing costs can improve, obviously, net property income and distributions. But at the same time, just a caveat, Singapore, the MAS is maintaining that slight appreciation of the slope of the Singapore nominal effective exchange rate. So that obviously can also impact some negative currency translations for revenue generated overseas. And as we said before, many of the REITs have international properties. On the borrowing front, the S-REIT sector started 2020 with an average gearing ratio of 35%. It has risen, but only risen to 39% on average, and that is still comfortably below that 50% regulatory limit and giving plenty of room for debt to fund growth and accretive acquisitions and so forth. So that was just a quick update that I wanted to provide, a quick broad opener. Please do scan that QR code if you wish to receive any more information from my colleagues at SGX. I'm really looking forward, as everyone now, to the presentation by Sulu and the management team. This is actually Asia's first US grocery anchored shopping center and self-storage REIT. I think, what is it? There's 20 freehold grocery and necessity properties, 2 self-storage all on the east coast of the US. And I think the net lettable area, from what I recall, is getting close to 4 million square feet. So I'm going to shush up and hand over to Sulu. Thank you so much.
Hey, thanks, Geoff. Thanks for sharing with us the latest markets updates. We look forward to hear more of your research, so do join us more often. We will now dive into the corporate presentation by United Hampshire REIT, and I'll pass the time to the Head of IR and Sustainability, Ms. Wong Sulu. Please go ahead with your presentation and introduce your team to us.
Yeah, good evening to all. Thank you very much for taking the time this evening to join United Hampshire US REIT's team at SIAS Corporate Connect webinar. So special thanks to Geoff, Sunny, and the SIAS team for hosting us today. So my name is Wong Sulu. I'm the Head of Investor Relations and Sustainability at the REIT Manager. Together with me, I have our REIT management team, including CEO Mr. Gerard Yuen, CFO Ms. Winnie Yap, and Chief Investment Officer, Mr. Derek Gadela, joining us from the US. All of us will be available to address any questions you have during the Q&A section later. I understand some of you might not be very familiar with the United Hampshire US REIT. Therefore, I would like to start this presentation with a brief introduction, starting with our sponsors. The REIT is named United Hampshire US REIT after our 2 strong and reputable sponsors, namely UHREIT Global Capital and the Hampshire Company in the US, who jointly own the REIT manager. Both are also our major shareholders and each own approximately 8% of the REIT. UHREIT Global Capital was founded over 20 years ago back in 1998. It manages over US 3.7 billion AUM and is a global asset management subsidiary of United Overseas Bank, a household name that we are all very familiar with. The Hampshire Company is a privately held, fully integrated real estate firm with over 60 years of experiences. They own and or operate a diversified portfolio of 180 properties across the US with AUM in excess of US 1.7 billion. Both sponsors have developed close partnership for over 15 years since 2008, where they jointly formed 3 funds with approximately US 1.3 billion of AUM to focus on investing in income-producing real estate in the US. Next page. UHREIT is Asia's first and only US grocery shopping center and self-storage REIT. In Singapore, we call it supermarket, but in the US, we use the term grocery store. Our grocery anchor shopping center in the US are single-story shopping centers located in the suburb. They typically have a supermarket as an anchor tenant with smaller shop next to it. For example, a DIY shop, health and beauty shop, or even a casual restaurant like a pizzeria. Our other asset class is modern climate-controlled self-storage property. As you can see from the map, we own 22 properties in total. They are all located along the US East Coast, which is very densely populated and has high income levels. Our properties are spread across 8 US states. From up north, we have New York, New Jersey, Pennsylvania, all the way down to Florida. As we cater to the essential day-to-day needs of our shoppers, UHREIT is uniquely positioned to benefit from the robust, essential, non-discretionary spending of the US consumer. Moving on. Since our IPO in 2020, UHREIT has been very successful in executing our portfolio and asset management strategy. We have been steadily growing the REIT and strengthening our presence and positioning in the S-REIT market. UHREIT asset under management has grown 31.4% since IPO to US 768 million. We have since acquired 3 yield accretive acquisitions and completed 3 rounds of divestment, all at healthy premium above valuation. Our most recent divestment, 2 freestanding properties within Hudson Valley Plaza, were sold at above both valuation and purchase price in the month of August this year. It is part of our proactive asset management strategy to maximize the operational performance and assets and capitalize on opportunities to improve UHREIT financial flexibility. In addition, we completed the construction of 3 new properties, namely a supermarket called Publix in Port St. Lucie, Florida, our Perth Amboy self-storage in New Jersey, and most recently, a brand new store spanning across 60,000 square feet for academic sports, which is also in Florida in November last year. I'm very pleased to share that in terms of total unitholder returns, UHREIT has performed very well in 2023. We were named the second best performing ex-REIT by Business Time, providing a total return of almost 23% in January this year. So with that, I concluded a brief introduction of United Hampshire US REIT. I shall now hand it over to our CEO, Mr. Gerard Yuen, to bring you through the key highlights and financials. Over to you, Gerard.
Thank you, Geoff, Sunny, and Siulu. Good evening, everyone. Thanks for joining us. I'll start with the latest on the US economy. The US continues to grow strongly, and the US consumer continues to spend strongly as well. US GDP has seen 8 consecutive quarters of positive growth. In the second quarter of this year, GDP grew 3%, which is higher than the initial estimates. And overall, the US economy is projected to grow over 2% this year. Unemployment remains low. It fell recently to 4.1% in September. And another big positive is, of course, that inflation has come down significantly and is now slightly above 2%. The big news, of course, as Geoff mentioned, is that the US Federal Reserve has now begun cutting interest rates. And they started off with a large 50 basis points rate cut in September, and is expected to continue cutting rates throughout the rest of 2024 as well as 2025. This will lower borrowing costs, and this will obviously bring significant benefits to US businesses and consumers. Mortgage rates have also come down significantly, which will boost home sales and transactions. Lower interest rates will also provide significant benefits to S-REITs like United Hampshire REIT. As you can see, our unit price has reacted positively to the news, and our borrowing costs will also come down with the lower interest rates. As you know, UHREIT, we own supermarkets located in the US suburbs. And so for us, it's the US consumer and their day-to-day non-discretionary consumption, which is important. And that continues to be strong. US consumer makes up 2/3 of the economy. And as they have shown throughout COVID, the Ukraine and Middle East conflicts, and the period of high inflation that we went through, people still need to buy their food, groceries, and other day-to-day essentials. And from what we've seen, they like to do their shopping physically in stores, and they are coming to convenient neighborhood shopping centers like ours to do this shopping. Industry reports also show that foot traffic across all types of retail properties are up year on year. But for grocery strip centers like ours, not only does it have the highest year-on-year increase, but it's also the only one where the foot traffic is actually higher than the pre-pandemic period by 7%. So overall, US retail sales were up 2.3% this quarter, and grocery sales also performed strongly, 2.5% higher than the previous year. Moving on to UHREIT's first quarter operational performance. This is as of 30th June. Obviously, we're in October already, and our 30th September figures will be coming up shortly. As our properties are located in the suburbs or neighborhoods where people live and now work, we've continued to be a big beneficiary of the work from home trend that we see in the US. Occupancy at our grocery properties has increased to 96.3%, with the addition of some very well-known new anchor tenants such as Trader Joe's. Self-storage occupancy also remained high and increased slightly to 94.3%, and rental rates are also staying strong. Our weighted average lease expiry, already one of the longest among S-REITs, remained very high at 7.7 years. Our tenant retention rate continues to remain high at 92%, and we have just 1% of leases maturing this year. On the financing front, we refinanced all our loans already, and we have no loans due until November 2026. That's still more than 2 years from now. In August, we sold 2 freestanding buildings within our Hudson Valley property. These were stores that were tenanted to Lowe's and Sam's Club. We sold these at very attractive price of 36.5 million, which is 17.5% higher than our purchase price and 4.3% above the 30th June valuation. We had recently extended the Lowe's lease by 12 years, and so was able to take advantage of this new long lease to divest at a very compelling premium price. Assuming the net proceeds are used to pay down debt, gearing drops significantly to 39%, and ICR will also improve significantly to 3.2 times. We have used the proceeds to repay our floating rate debt, which is the relatively higher interest rate. So this will also reduce our interest costs going forward. This sale is part of our overall proactive portfolio management strategy to optimize performance and value from the portfolio and significantly improves the REIT's financial flexibility, allowing us to pursue better growth opportunities. The sale was completed in August. In terms of leasing activity, the grocery anchored sector that we're in remains very strong, and occupancy and rental rates are remaining near their all-time highs. Demand from tenants for retail space also remains very strong. And at the same time, there is a significant undersupply of new retail space. This is due to high interest rates and high construction costs. As a result, we see very strong demand for space at our properties, and we have been achieving very good leasing outcomes and rental rates. The most exciting new lease is that of Trader Joe's, an extremely popular grocery brand with a very loyal and strong customer following. We have signed them up as our new anchor tenant at Lincroft, and this not only increases occupancy at Lincroft to almost 100%, but it does add an exciting new buzz to the property. Once the store finishes its fit out, which should be quite soon, it will provide a significant uplift to the REIT's NPI. Since the 30th June cutoff as well, we have signed even more major new or renewal leases, and these will also further improve our occupancy and will. Of some of these that we mentioned, first one is the new 53,000 square feet lease that we signed with Dick's Sporting Goods at Hudson Valley. Dick's is the leading sports retailer in the US with over 800 plus stores. This is a big achievement for us because they have taken up a very large space, which was recently vacated, and brings our occupancy at Hudson Valley to almost 100%. Similar to Trader Joe's, this will provide a good uplift to our future NPI. We have also executed several long-term lease extensions with our large tenants. I mentioned the 12-year extension with Lowe's, but we've also signed a long-term lease extension with Crunch Fitness. The next slide. This is just a few of our recent large store openings that we've had. On the left, you see the new Market 32 grocery store. This recently reopened at Albany. Market 32 is a very popular upscale brand of Price Chopper supermarkets, and they offer a wide range of food and fresh produce choices. This is a new store format which supports their omni-channel retail strategy by offering buy online, pick up in store options. If you recall, we shared that Price Chopper did extend the lease at this property by a further 6 years, all the way until 2038. That's about 14 years from now. On the right is a new 47,000 square feet store for Dick's Sporting Goods at Upland, which just had its grand opening. This store used to be Bed Bath & Beyond, and when they moved out in 2023, we managed to not only bring in a much better tenant, but the tenant is also taking up a much larger space and at a much more attractive rental rate. So overall, very positive improvement for the property. Now I'll move on to our first half financial performance. As I mentioned, we're already in October, so I won't spend too long on this. But as you can see, our top line has continued to be strong. Revenue for June is up 1.8% from second half of last year and 2.4% higher on a year-on-year basis. The increase in revenue is due to the new leases we have signed, contribution from the new large Academy Sports Store, which opened in November 2023, and from built-in rental escalations of our existing leases. NPI, or net property income, is up 2.4% from the previous period. On a year-on-year basis, it's slightly down by 1.7%. This slight decline is largely due to the absence of Big Pine Centre, a property that we had sold in August last year. In terms of distributable income and DPU, we did see a modest drop from the previous period of about 7%. Compared to the previous year, the drop was about 15%. This drop is mainly due to higher interest rates. And the year-on-year change is slightly higher because last year we were still paying a very high DPU due to lower interest rate swaps we had entered at IPO. These swaps have since all matured, and now all our existing interest rate swaps only mature in December of 2026. As at June, our floating rate loans comprise 32% of our outstanding debt, so we stand to benefit significantly from upcoming interest rate cuts. In addition, we also have contributions from the new tenants and leases that I spoke about, so we have something to look forward to in terms of the coming quarters. In terms of capital management, I mentioned that we have refinanced all our loans, so we have no refinancing requirements for more than 2 years. In terms of the metrics, you see that with the sale of Lowe's, of course, that's improved significantly as well. Our pro forma gearing would be down to 39%, as you can see from our divestment announcement, and our interest coverage ratio, instead of 2.5 times, would be 3.2 times. Weighted average debt maturity is 2.8 times, and 68% of our loans are hedged to fixed rates. This is our balance sheet. As you can see, our NAV, net asset value, remains relatively stable at 74 cents over this period. In terms of total shareholder return, I think Geoff talked a little bit about this as well. UHREIT, we offer a very attractive yield. As at June, it was about 11%, which is more than 6% higher than the US 10-year Treasury yield. Our price-to-book ratio is 0.53 times, which is quite attractive. And I think, as Geoff mentioned, the target price of the analysts for us is averaging 60 cents, whereas we're at 48 cents today. And now let me hand over to our Chief Investment Officer, Derek, to take us through the portfolio update.
Thank you, Gerard, and good evening, everyone. Today, I'll begin by going through the portfolio highlights and our outlook. To start with the portfolio highlights, for the half year ended June 2024, UHREIT's grocery and necessity portfolio increased occupancy to 96.3%. During the same period, 13 new and renewal leases were completed, comprising nearly 350,000 square feet. These leases comprise tenancies across grocery, fitness, and home improvement sectors. We'd also like to highlight that over the next 4 years, there is minimal lease expirations across our portfolio. On the next slide, we'd like to highlight to you our top 10 tenants. And our top 10 tenants serve the needs of the U.S. consumers through providing essential goods and services. 90% of our top 10 tenants provide essential uses to the U.S. consumer. We are fortunate that our top 10 tenants have a long WALE of 9.4 years and comprise discounters, grocery stores, wholesale clubs, and home improvement stores. Additionally, nearly 62% of the tenants across our entire portfolio are focused on essential products and services benefiting the U.S. consumer. These essential tenants have a WALE of 8 years. Across the self-storage industry, fundamentals continue to normalize, while our assets demonstrate stable occupancies with rents remaining high. Since our IPO in 2020, UHREIT has successfully managed to sustain strong occupancies and grow rents at both of these properties. And on the next slide, we'll go into more details about our grocery and necessity portfolio. We always like to showcase the strength of our tenants and include commentary, and in particular, in this presentation, we're including commentary on Dick's Sporting Goods, who recently opened a store at our Upland Square property. In totality, Dick's Sporting Goods is a publicly traded company, experienced meaningful sales growth on a year-on-year basis. Also, both Publix and Walmart have produced increases in sales during their quarterly earnings announcements. Additionally, Walmart saw e-commerce sales being led by in-store fulfillment of goods and pickup delivery out of the physical store, emphasizing the importance of the physical store in the product distribution process. Publix also increased 3.1% during the last 3 months for the period ended June 29th when compared to the same period over the prior year in terms of sales. On the next slide, we'd just like to highlight that as an organization, UHREIT is very committed to sustainability initiatives. Over 50% of our properties benefit from LED lighting, and we are highly focused on exploring opportunities for solar and EV charging stations within our portfolio. We also engage with our local communities and are committed to achieving 100 volunteer hours for 2024. And now I'd like to move into the outlook. As we look forward, omni-channel retailing continues to be at the center of a retailer's success by offering the consumer multiple ways to pay for and pick up goods. The physical store serves as the last mile distribution hub as consumers have multiple options for how they pay for, pick up, and receive their goods. Examples across the market include 81% of Target sales volume being originated from the physical store, while more than half of Walmart's online orders are fulfilled out of the physical store. We'd now like to just highlight some key interesting points across the grocery, necessity, as well as self-storage sectors. In the grocery and necessity sector, the landlord-friendly supply and demand backdrop is forcing retailers to demonstrate flexibility in adapting their store to different store sizes, also their store opening schedule and other conditions to match available space in the marketplace. Limited space is available, so retailers have to adapt their store sizes to those spaces that are available in the marketplace and where they want to open stores. As you can see from the chart on the left-hand side of the page, there is a minimal shopping center supply growth forecasted over the next 4 years. So because the shopping centers are larger in size, they may take several years to get approval to be constructed in certain cases. And as we look at this, due to historically high interest rates, as well as elevated construction costs, there is a minimal new shopping center supply coming online over the next couple of years, leading to a defined limited amount of space available for lease, where we have a situation in the US where there is strong tenant demand for retail space in good locations. And so, as you can see, the requirement for the physical store is of utmost importance to retailers, which benefits our shopping centers. On the self-storage side, self-storage continues to remain a favorable option to the consumer when compared to the cost of a larger apartment or a larger house. So having that optionality by the consumer in leasing a larger self-storage unit is much more cost-effective than moving up to a larger apartment or purchasing a home. Also, while the self-storage sector has continued to normalize, limited home sale activity is continuing to have somewhat of an impact on move-in rent growth across all markets. On the next slide, we want to highlight that strip center and self-storage property values have remained resilient over the last 4 years. As you can see, the healthy gains in these property types have been robust despite interest rate volatility. We also want to point out that the media has unfortunately correlated broad commercial real estate values with the office sector. As you can see, all property sectors in the US shown on this page have outperformed office. Additionally, the office sector behaves very differently than strip centers, grocery and necessity properties, and the self-storage sector. Overall, UHREIT's real estate sectors continue to perform well and benefit from the demand for essential retailers, close proximity to the consumers' homes, and strong demand across the marketplace for space. And now I'll turn over the presentation to Sulu.
Yeah, thank you, Derek and Gerard, for their detailed presentation. Before we dive into the Q&A section, I'd like to showcase a short 2-minute video featuring our property Upland Square Shopping Center in Pennsylvania. Spanning across 400,000 square feet, Upland Square is home to over 30 tenants and stands as the newest addition to the UHREIT portfolio. Please play the video now. Thank you.
Welcome to Upland Square, the preeminent grocery-anchored shopping center in Pottstown, Pennsylvania. Acquired in July 2022, Upland Square is the latest addition to United Hampshire US REIT's portfolio. Upland Square is a regional hub of consumer activity and is 100% leased. It offers a wide variety of customer buying options, an exceptional open-air shopping experience, and ample vehicle parking. Located directly off Route 100, less than 2 miles from the Route 422 interchange, Upland Square benefits from easy accessibility to these highly trafficked regional roadways and has premier visibility to over 23,000 residents of Pottstown, Pennsylvania, making it a trusted shopping option for both local and regional consumers. Spanning over 400,000 square feet, Upland Square is a freehold property and is home to 36 tenants, including prominent anchor tenants Giant Food, an American supermarket chain with over 160 stores in the US, and Burlington Stores Inc., a Fortune 500 company with over 900 stores offering low-priced brand name merchandise. Shadow anchor tenant Target, a general merchandise retailer with stores in all 50 US states, further increases traffic to the site. Upland Square provides consumers with a one-stop shop model, while its tenants offer a range of buy online, pick up in store, omni-channel shopping options to effectively meet the advancing expectations of today's consumers and ensure their satisfaction. Deeply committed to environmental sustainability, Upland Square features a stormwater retention system, solar panels on the roof of Giant Food, energy-efficient HVAC systems, eco-friendly water fountains, and electric vehicle charging stations, which help reduce its carbon footprint and provide additional value to its patrons. With a diversified and deep tenant base, a premier location with abundant omni-channel shopping options, and a commitment to sustainable practices, Upland Square continues to meet the evolving needs of today's consumers and is a valuable piece of the UHREIT's grocery and necessity-based real estate portfolio.
I hope you find this video insightful. Seeing is believing. The team has curated a total of 9 videos for our All About UHREIT educational series, where we spotlight our properties through dynamic video content. You can view all episodes on UHREIT LinkedIn page and our website. So do follow UHREIT LinkedIn page for the latest updates and more educational content. With that, I shall now hand the time back to Sunny to moderate the Q&A section. Thank you.
Thank you, Sulu, and thank you, Mr. Gerard and Mr. Derek, for your insightful presentation. We will now move on to the Q&A segment. So please feel free to submit your question in the chat. I do see quite a bit of questions coming in. And for our Mumu audience, you can click on the link to join us in the Zoom session to post your questions as well. We endeavor to answer as many questions as possible. So now let's proceed to the Q&A session. We will go down the list. The first question is, borrowing costs have risen from 2.77% to 4.93% and seems still on an uptrend. When will this be expected to come down? Maybe anyone on the management team would like to take this question first?
Yep, thank you. First of all, thanks very much for the questions. So yeah, I think you've been a loyal unit holder, because I think 2.77, that was back in 2022. Yes, interest rates, as we all know, in the US, interest rates moved up significantly from that period of time. We were actually, we managed to weather a lot of that because we had entered into interest rate swaps at the IPO in 2020. And that's why, in 2022, our interest rate was still very low at 2.77%. Over a period of time, those interest rate swaps, we did do a few tranches of them to spread them out. So as each tranche matures and we enter into a new swap or we move into a floating rate loan, the overall average interest cost will trend upwards because we no longer benefit from the lower swaps. I think the good news and very important is that all the older interest rate swaps, they've all matured already. All the existing swaps that we have now, they don't mature until December of 2026. So in other words, more than 2 years from now. So really, I think when we talk about the direction of our interest rate movements, what you can expect is that for our floating rate loans, which is about 32% of our total loans at the moment, that will be directly linked to the interest rate cuts that we've been talking about. So, when the Fed cuts 50 basis points, we would expect that component of floating rate loans to come down, and that will also bring our average interest costs down as well.
Hey, thanks, Mr. Gerard, for that answer that I hope will give the viewers more insight into how UHREIT manage the interest rates and the borrowing costs. So the next question from the same viewer is ICR, which I believe is the interest coverage ratio, has reached the critical 2.5 level and is still downtrend. Together with the 41.9% gearing, how can the REIT improve these levels?
Thanks. I guess you read our mind. And so what we did was we divested the Hudson Valley, the properties at Hudson Valley, the Lowe's and Sam's Clubs that we mentioned. So unfortunately, because this presentation is based on a 30th of June cutoff, we haven't fully captured the impact of the divestment yet. The sale was completed in August, in mid of August, and we have proceeded to use the proceeds from the sale to repay some of our debt. So you would have seen from the divestment announcement in August, the pro forma gearing after we repaid the debt comes down to 39%. That's exactly the industry average that Geoff mentioned earlier in his presentation. And our interest coverage ratio goes up to 3.2%. So very healthy numbers now that we've divested those two freestanding buildings.
Okay, thank you, Mr. Gerard, for that answer. The next question would be, the percentage of loan hedged to fixed rates has dropped from 80.9% to 67.8%. Can you explain the management team reason for doing so?
Yeah, that's a very good question. So as I mentioned, we did have existing swaps that we did back in 2020, which mature over time. So then the question is when do we elect to enter into new swaps to hedge them back as well? What we have done is that we have, when some of these swaps matured, we have hedged a portion or an incremental amount. I think part of the reason is, as you know, interest rates are quite volatile. They can move up or they can move down quite a bit. So what the approach we've adopted is that to do smaller size swaps over a period of time, so that way, you may never get the best rate all the time, but you may not always get the highest rate all the time as well. So this allows us to spread out the eventual swap rate that we're able to get. And because, I think most people would say that the interest rate forecast in the US is definitely downwards, and question about how steep the downward movement is. I think we've been comfortable to leave more of the interest rates unswapped for now, because as interest rates come down, you are able to actually enter a swap at a more attractive level as well. So there's also a slightly tactical element that, we're monitoring the market to look for opportunities when the market does drop significantly to do more swaps over a period of time.
Okay, thanks, Mr. Gerard, for that answer. I'm no expert at the interest rate forecast, but looking at the Fed Fund futures pricing, it looks to be going to the 4% level in the mid of 2025. So I believe that would be good news for UHREIT as well. And we look forward to the latest earnings that will be coming up soon. So let's move on to the next question. The REIT does not really share rental reversion data in the business update, which is coming up. And unlike the other REITs, is it possible for the REIT to share this data with us in the future?
Yeah, that's a very reasonable question. Part of the reason we don't disclose specific rental reversion numbers is we have, as you know, we have a very high occupancy and very low WALE, very long WALE, which means actually the number of leases or the number of tenants that we renew is relatively small each year. Sometimes if we just give you that information, sometimes the number may be a little bit misleading. So if we have one big tenant only this year, it may give you a very skewed number, either up or down. I think so. What we do is typically we report the rental reversion on a once a year basis as opposed to on a quarterly basis. Because other REITs that do a lot more leases because they are much shorter leases, they have to do a lot more renewals. They have a lot more data points. And the reason why the second reason is also if we were to disclose detailed rental reversion information, sometimes because there are so few leases, it actually discloses the specific rental rates that some of our tenants are paying. And so that's obviously in many cases that's confidential. So because of that, we tend to share a more broad-based annual reversion data.
So that is valid as well, because that is some kind of a business secret that we want to withhold so that you can be able to price your rentals more competitively. So I thank you for that answer as well. The next question will be some of the more recent news that we see. TGI Friday, possible bankruptcy. We saw the news recently. What is the exposure of the REIT to TGIF and what can be the impact?
Yeah, I think it's just, it's really a coincidence that we had actually extended their lease. And that's why I think maybe the question came up because they saw the logo on our investor deck. But they're not a large tenant. We have one TGI Friday. I think they've got one restaurant that's a few thousand square feet, like 5,000 square feet. So it's actually a really, really small tenant. I do understand why the question was asked because it's quite a well-known name. And it is in the news that they are going through a bit of challenges and difficulty. I think the other point I'd add as well, and I'll elaborate a bit, is that we always do see, it's always possible that smaller retailers will, some retailers may go through challenging times or difficulties, like TGI Fridays. In the current scenario where we're at, and maybe I'll ask Joey to move to the slide that talked about the grocery and necessity supply. So Derek and I had tried to elaborate, but it's really important to highlight this point at the moment. It's a very, very strong market for landlords at this point of time. There is a very little supply coming on stream. If you look at the chart, which hopefully will appear shortly, it's almost zero. It's 0.3% of new supply coming. And so, tenants are really, they're fighting quite hard to find space. And as a landlord like us, where we do have, good retail space, we're able to negotiate for very good rental outcomes. So this is the chart that shows you the upcoming supply. It's virtually zero. And that means, it makes our life very good because we can really negotiate for much better rental rates. So to give you an example of a recent success, we had 2 Bed Bath & Beyond in our portfolio. If you remember, last year in 2023, Bed Bath & Beyond also closed down their stores. So we actually had 2 vacancies. But actually, because the dynamic is so strong in our favor, we actually got really great outcomes. The first Bed Bath & Beyond was replaced by Trader Joe's. For those of you who are familiar with the US supermarket scene, Trader Joe's is a very, very popular, really niche, but really popular supermarket chain. People are so excited that this one is coming to their town. There are many chat groups, discussion groups getting excited about when they're going to open, because they sell a lot of their own branded products, which you can't get anywhere else. It's a really popular supermarket chain. So what we were able to do is we replaced Bed Bath & Beyond with Trader Joe's, and we replaced them at a much higher rental rate as well. The second Bed Bath & Beyond was replaced by Dick's. The Dick's store that you see on this page, they took over Bed Bath & Beyond, and they didn't just take over their store, they took over the store next to it as well. So they doubled up the space that they were taking. And again, similar to Trader Joe's, it came in at a much higher rental rate as well. So in the current market environment, it's actually, to some extent, of course, you never want to see tenants leave, but to some extent, it's an opportunity for the REIT rather than a concern. Because with the strong demand, what we've been able to achieve in the current market is we get better tenants to replace tenants who move out, and we're actually getting much better rental rates and longer lease terms as well.
So to round it up the answer, which is the next question, any other tenants facing financial challenges apart from TGIF? So it's actually not a concern to worry about because it presents an opportunity for the REIT to upgrade to a better tenant and even possible positive rental reversion as well. Is that correct or understanding?
Yeah, I think that's fair. It will change depending on underlying market conditions, but in the current market, I would say yes, we do see it as an opportunity. There are always tenants that you can read about that maybe are going through troubles, some maybe just for a strategic shift may choose to exit certain towns or certain states in the US, and focus on other states where they're doing better. So there'll always be an element of turnover or, just tenants, or maybe some of the smaller tenants, the single owners who maybe they're retiring or decided to call it a day. So there'll always be turnover. The question is, how do you optimize the outcome from that? And I think as a proactive asset manager, I think we've been able to achieve very good outcomes from such situations.
I think that gives a lot of assurance to our investors that they do not have to worry about challenges some of the tenants are facing. To the next question, more than half of the loans would mature in 2026, and that may pose a risk during refinancing. So would the REIT consider in future to spread out the loans more evenly across multiple years?
That's a great suggestion. Maybe I'll ask them to move to the slide showing our debt maturity profile. We do try to do that. The suggestion is a very good one. Actually, if you look at the dotted bar, the 75 million, that's actually due to mature in 2025. But we have a 1-year extension option at our discretion, not at the bank's discretion, but at the REIT's discretion. So actually, if you before we exercise that extension, if you look at the debt maturity profile, I would say it's pretty well spread out. It's nothing this year. At the end of 2025, 70 million, maybe 100 million the following year. It is quite well spread out over 5 years. Now, the reason why it looks to be all in 2026 is because the loan that we're looking at is a syndicated loan, a syndicated bank loan. So in other words, you put together a syndicate of banks. There is one loan facility agreement that with multiple tranches as well. And the benefit of doing this is obviously costs and efficiencies and economies of scale, right? So if we were to do, let's say 10 loans with 10 different banks, it would actually be very expensive for the REIT because you need to have 10 loan agreements, 10 sets of lawyers, 10 sets of valuers, and so on. So there is a trade-off, I would say, a nice balance between having a more diversified bank group and a more diversified maturity profile. But also, by combining the properties into, this syndicated loan structure as well, it brings a lot of cost efficiencies for the REIT. So, when it comes to 2026, I think we have demonstrated that we proactively refinance way ahead of schedule. So, we will make sure that this is refinanced, and I'm pretty sure that when we refinance it as well, we will spread out the maturities and not have them all in the same year as well. So thanks for the suggestion.
Yes.
We will take it on board.
Thanks for assuring the investors that we can look at spreading out the loan more evenly across multiple years. Okay, the next question is from Michael. weighted average interest cost at 4.93%, we covered that earlier, is on the higher side relative. And with 67.8% in fixed rate arrangement and the renewal of loans only in 2026, does it mean that we won't be able to see the benefits of the rate cuts that are coming next year?
So we will on the 32% floating rate. So 67.8% is in fixed rate. So yes, you're right. Those will not change during the period of the loan until we refinance it. But there's 32%, which is quite a significant amount. It's almost, I think, slightly under 100 million. But that is on a floating SOFR rate. And SOFR is the rate that the Fed is cutting, right? So that used to be 5.3%. They've cut it by 50 basis points. So we would stand to benefit directly from that 50 basis points cut on the, close to 100 million of floating rate loans that we have. And obviously that will then filter into the average interest rate, which will then, we expect to see come down over a period of time. So, which is also why I mentioned technically we didn't hedge all our loans, because if we hedge all our loans, we wouldn't benefit from any falling interest rates.
Okay, thanks for that insightful answer on how the interest rate will impact the average cost of interest for the REIT. We are at 8:01 now. We still have 3 more questions to go. So I thank the management team for staying with us. The next question, first half of 24, 15.5% drop in DPU is quite significant. How much is it due to the higher financing costs and how much due to the management fee in cash? Well, what determines whether the management fee is in cash or in units?
Sure. Maybe I'll start with the second part first and come back to the first question. Management fee in cash versus management fee in units. So, to elaborate, the manager of the REIT, you can choose to take cash or you can choose to take units when you are receiving your quarterly fees. Initially when we did the IPO, we were taking it in the form of units because that will enhance the DPU for unit holders. But because of interest rates moving up, with all the situation we've seen of COVID and inflation rates, when interest rates go up and REIT prices came down, we were issuing the management fee units at the current share price. And that's quite far below NAV. I think most of us, especially, I'm an existing shareholder. If you're an existing shareholder as well, you would probably think it's not great to be issuing new units at the current price because the NAV is significantly higher at 74 cents. So one of the feedback that we receive from a lot of unit holders is that they would actually prefer that we not issue units issue fee in the form of units because it's quite dilutive to issue it at the unit price. And the second challenge that we have as well is because, obviously when we receive the fee in the form of units, this fee is to pay for operational expenses, the day-to-day operational expenses. So from time to time, we actually have to sell these units in the market as well. And that causes a bit of a downward pressure on the unit price. So it's a bit of a double whammy from investors' perspective. So there was a lot of feedback that maybe given the current share price, taking the fee in the form of cash would be better, which is what we moved to. And we've done that. And I think we have received quite a lot of feedback from investors who are quite happy that we have moved in that direction, even though it ultimately does impact DPU to some extent. But I think back to the first question, yeah, I think it's really the majority is due to the higher financing costs. I guess I can't stress enough that in the early part of last year, so when you look at this year versus exactly 1 year ago, we were still having a lot of the low interest rate swaps. These were interest rate swaps that we had entered when interest rates were close to zero. So the swap rates that we entered were, somewhere in that very low range, right? So we were really benefiting from a very low interest rate, and that means a very high DPU last year. So that's why when you look at a year-on-year comparison, I feel it sort of overemphasizes the gap while the difference has moved. But I think if you look at an absolute yield and return basis, I think we are still performing quite well, even though the year-on-year looks, the drop seems to be a bit on the high side.
Thanks for that answer. I hope that gives our audience a bit insight on the DPU and how management fees are being paid, whether in cash or in units. So the next question that we have is UHREIT consideration into expanding into data center or logistics center. Any thoughts on that?
Yeah, I think a lot of people are very excited to look at those sectors. I think we do specialize in our two sectors, grocery and necessity and self-storage. We have we meaning both UOB and Hampshire have a long track record in this space. They manage a private fund before the REIT, and the REIT's been around for almost 5 years now. I think we like our sector. Obviously, as the REIT grows, I think we will look to potentially expand asset class, geography. I mean, all of these are on the table. But I think given where we are now, given just how well our sectors are performing, and we just feel that this is a great it's a great asset class for investors in Singapore to get exposure to, because it's shown itself to be so resilient, even through all the various volatility we've seen in the market. I would say probably while we will never say no to expanding and growing the REIT, it's probably not our top priority at this point of time to expand into a data center or logistics.
So thank you for the answer. Our audience do have some comments on that. So groceries are closely related to logistics, and it may be a seamless synergy or the flow of revenue, just like what Amazon did in their logistic arm as well. So any further comments on that? Would the REIT be looking at it in the near term, or maybe consider it in the further terms?
Yeah, it's a very good point. I mean, I guess even internally as a group, when we look at it, I think the investor is spot on. I mean, this would be the sort of the closest asset class probably that we would start looking at, if we start expanding beyond this. I don't want to go too much into this kind of strategy. It really is just the management strategy. So I think, to the unit holder, it's a very valid point. It is a good point, and like I say, we'll never rule it out, and it's definitely much closer to us than data centers. So it is a very fair point. But maybe just in terms of the immediate future, it will be maybe second tier or second part 2 or part 3 of our growth as a REIT. But thank you.
Okay, so if there's any developments there, I believe the REIT manager will share it with us or through some of the business updates. So the next question, back to the DPU. Will the divestment of the 2 properties in Hudson Valley affect the DPU? And what is the planned use of the divestment proceeds apart from repaying the floating rate loans?
Sure. The divestment announcement in August, we did disclose the DPU impact. There was a very minor 0.02 change in DPU that we disclosed. That was based on last year's interest rates. So obviously what we're doing is we're using it to repay floating rates today, right? I mean, as of August. And so the short answer is that, when we sold the property in August, the floating rate loans were more expensive than the cap rate at which we sold the property. So if you look at it that way, then it's DPU accretive, right? It's going to be positive to DPU because the yield you're getting on a property is lower than the interest rate of the loan that you're repaying. In terms of the second question, what's the planned use? I mean, what we've done is we've pretty much used all of it to repay the loans first, because the loans are quite expensive on a floating rate basis. So we don't hold surplus cash. We have used it to reduce our loan. But I think what maybe the unit holder is suggesting, and I think it's a very intelligent point, is that this does give us quite a lot of debt headroom that we can then go out and buy better assets. And I think that's one of the points that Derek and I wanted to make as well, which is that, this is part of our proactive asset enhancement and recycling, right? We use it to bring down gearing now, but it also gives us the ability to then potentially buy much better assets that contribute to the overall portfolio in terms of yield, diversification, and income stability.
Thank you. So we have come to the end of the list of the Q&A that our audience has submitted. Before we end the webinar, may I ask just two questions on behalf of some of the unit holders that I spoke to? One of them actually asked me to check with the management team, what is the future DPU outlook in view that the US Fed rate should be coming down next year, according to the Fed fund pricing. So is that a positive sign that we can look forward to with the rates coming down? DPU should be increasing next year. And is there any factor we should look out for that could impact the DPU?
Yeah, thanks for leaving the most complicated question to last. But I mean, there are many components that impact our DPU. We spoke about interest costs. So as I mentioned, 30% of our loans in floating rate, that's going to be a direct beneficiary of interest rate cuts going forward. So I think that's going to be a positive contribution. We also spend a lot of time talking about the leasing, the strong new leases that we're signing, right? The ones I mentioned about Trader Joe's and Dick's. These are at rental rates that are significantly higher than the tenant who moved out. So obviously that's going to be a very big uplift to the overall NPI and revenue of the REIT. So again, we have this to look forward to, as the new tenants, once their fit out is done and they come on board, I think there's a very positive momentum that we're looking forward to on the leasing side as well. So, hopefully, I can't give you the final answer. Nobody knows what DPU will be at the end of the year. But, I think a lot of the contribution factors into the DPU are on a very positive trajectory at this point of time.
Wow, that's a very positive answer, and we look forward to the next business update from United Hampshire REIT. And lastly, we hear some news of the hurricane in the US recently. So don't want any surprises in some of the upcoming business update. Is there any impacts of all this natural disaster on United Hampshire REIT as well?
Short answer is no. I mean, obviously, if there was a big impact, we would announce it as well to any of our properties. We all looked at news. As you know, America is a very large country. So even when we have properties in North Carolina, and when the Hurricane Helene went through North Carolina, it didn't affect our particular properties. So we're quite fortunate. I mean, obviously, we do hope the best for those who were affected, but in terms of our properties, generally speaking, it is one of the considerations in terms of location and susceptibility to such natural disasters and impact. It is one of the considerations we look at when we buy our properties. And we're just very fortunate at this point of time that the properties that we own have not been affected by the recent hurricanes.
Thanks for that assurance from CEO Mr. Gerald. So I think that is all the time that we have. I'd like to thank the management team as well for giving us your insights on the business that you are sharing with us today. And we hope that our audience and the unit holders found this Corporate Connect session very informative and useful. If you have further questions, you may check on the LinkedIn of the REIT, and of course get in touch with the IR. Okay, feel free to contact the IR of United Hampshire REIT. In case you miss any of today's session, you can actually rewatch this webinar on SIAS Facebook and YouTube channel. And Corporate Connect is our bi-weekly webinar where we will host some of our listed companies and REITs on our webinar. So do visit our website to get updates on the upcoming investor education programs and initiatives. And our next Corporate Connect session will be on the 29th of October featuring UHREIT. You may also type in the chat box to let us know which listed company you would like us to feature next. And lastly, I would like to thank everyone for joining us today. I wish everyone a good evening. Take care and have a good night. Good night, everyone.
Thank you, everyone.
Thank you for having us. Thank you for your time.
Thank
Bye-bye.
you.